This demonstration is designed to instruct you on using MetaStock software and accompanying plugins. It is not a recommendation to buy or sell exchange-traded instruments, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented should only be used by investors who are aware of the risk inherent in trading. Thomson Reuters shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company.
First off, Kelly, thanks for having me here tonight. I am Andrew Hart. I run and have created ETFtrader.com, which is a part of BigTrends.com. And as the name implies, obviously, I focus 100% on ETFs, which are exchange-traded funds. And we actually have, towards the end of today, I'll give you a very quick just tour of ETFtrader.com, just so you can understand what we do if you are interested at all. As you can see there on the bottom right of your screen, we do have a sign-up where you can get a free report plus market timing on a weekly basis on specific major market ETFs. So lots of good stuff tonight, but as the title implies, we are going to be covering and focusing mainly on 3 ways for you to determine market tops and bottoms, or as we said, market reversals. So let's very quickly start from an overall, more of an aerial view of what we're going to be talking about before we really get in-depth into everything. Just from a very broad stroke basis, the 3 signs that we're really going to be looking for and examining today, which you'll be able to look at the market today and say, well, are we going to be headed higher from today or headed lower? And my goal here with this today's Tradecast or webinar is to really give you the power to look at the market on just about any time frame. We're going to focus today on daily and weekly, and be able to determine based on that time frame whether the market is going to be headed higher or lower over, let's say, the next 7 to 12 bars. And we'll say bars because we will be looking at different time frames. But number one, very important for everyone to understand, as for those of you that know who BigTrends is, we've been around since 1999, and we've been built on the idea of contrarian trading, specifically on sentiment, and the idea that the majority of traders are wrong, and that obviously when certain things like the VIX show extreme fear, that's a good time to buy, or conversely, when they show extreme complacency, that's a good time to sell or exit a position. The 2 things that we'll talk about today are, of course, the CBOE Volatility Index, the VIX. The other thing that we'll mention is the EPCR, the equity put call ratio. These are 2 things that you don't have to come to me, you don't have to come to BigTrends to get. These things are freely available on the internet that you can check out yourself. The VIX, of course, is going to be available in MetaStock. The equity put call ratio we input every day from the CBOE website into the downloader on MetaStock, and basically that's how we notify our subscribers. But the information itself that we aggregate is available on the CBOE's website. And effectively what that stands for is the equity put call ratio, and what that's going to signify is a total number of puts divided by a total number of calls in equity only. So actually we're not talking about ETFs when it comes to the equity put call ratio, because as you know, if they incorporated calls on inverse ETFs, that would just throw off the entire indicator. So luckily the CBOE was smart enough to only include an equity only put call ratio. So the idea with both of these, as we'll see, is that when extreme fear hits, the question is how do you measure extreme fear? That's a good time to buy, and obviously when you see extreme complacency, it's a good time to sell or exit. So the key here is really knowing how to measure and turning this into an objective science rather than just assuming that we're at a fear, but on a relative basis, it's really nowhere near. So we'll be able to show you exactly what we mean by that. Next, we're going to be looking at the trend analysis with %R, and we'll also be using another indicator called parabolic stop and reversal. With our %R that we'll be looking at today, it'll be basically a little bit different than the %R you're used to. We take %R, which is traditionally on a negative scale of 0 to 100, and we take it and we basically, on the BigTrends toolkit with MetaStock, taken and added 100 to it. So basically it goes from 0 to 100. It really simplifies the process of just quick, spot-on analysis by looking at it without having to say, well, negative 80 is weaker than negative 20, which is obviously for some people a little bit more. But by adding the 100, it makes it very, very simple. And we'll take a look at that. It's probably the most exciting part of the presentation from the standpoint of usefulness. I get, that's not my personal feeling, but from whenever we do educational webinars and talk about this trend analysis with %R, we get the most feedback about that specifically. People just always say, if only I would have known this before today, so on and so forth, stuff like that. So I think you'll find a lot of usefulness in that you can put to work as early as tomorrow. Or for those of you trading Forex, put to work right now. Thing and final is that we'll be trading is support and resistance. This is probably the most objective thing out there for traders. How many people have looked at, on any given day, you can go and surf 20 different financial blogs, and let's say 10 of them draw support and resistance lines for the S&P 500. Let's say they use the SPY, which is the S&P 500 ETF, spiders. Well, you might see 10 different support lines, 10 different resistance lines, all basically drawn by hand on a individual's subjective view of where this might be. And they might be looking at different time frames. So basically what we're going to seek to do tonight is give you some very hardcore objective levels to always look at that will be set by moving averages effectively. So you don't ever have to look and go back and draw lines. They're going to be drawn for you. But something that you can actually stick your hand on, and something tangible that can give you somewhere to move from on a regular basis without having to go ask for assistance in the future. So let's go ahead and get started here. First off, I want to talk about sentiment. 5 things to know about the CBOE Volatility Index. You've got to understand volatility in order to help protect your profits, because the Volatility Index is probably the most widely known sentiment indicator, but it's also the most widely abused. Too many people think they know what it means. Too many people don't understand how to quantify a big move or a small move, or what is an extreme in the Volatility Index. So basically, let me go through a couple of quick things. Those of you that didn't know, the VIX is calculated based on SPX calls. It's looking at 2 expirations. So it's looking at your front month and your second month. For those of you out there that are options traders, what month are we looking at? We're going to be looking at August, and we're going to be looking at September. It's going to be looking at several strikes that are around the at the money, in the money, and out of the money, and taking an average of those implied volatilities. Those implied volatilities are set by what? They're set by the market and market participants, right? Whatever a willing buyer is willing to pay to a willing seller. And that implied volatility represents what on the VIX? The expected move in the SPX, right? So if we're looking at the total implied volatility on SPX options, if that's rising, people are expecting not only a bigger move, but really it's uncertainty. So they're pricing in uncertainty, because we know the VIX, or implied volatility, rises or expands as more fear comes into the market. And as more fear or uncertainty comes into the market, people don't see a reason, or they can't make a justification to keep their money in the market. So then it leads to selling. And that's really why you see the VIX that is inversely correlated to the market. Basically what we look at, as you did know, there are several different products from the CBOE that track volatility. I've looked at a lot of these for timing ETFs like USO or the Qs. They provide volatility indexes on gold, which can help you time GLD. They help you on VXO, VXN, which can help you time the Qs, or the USO, which is the oil ETF. So 9 total products that track implied volatility. Again, they're looking at the underlying index using the exact same algorithms or calculations that they use for the original VIX, or at least the current SPX VIX. a lot of people want to say that the VIX is skyrocketing, like it was in 2008, like it was earlier this year. But in reality, the VIX trades in a range. It's going to break that range every once in a while when you have those extreme moves. But by and large, going back to 1993, you're going to see the VIX typically trades in a range of, on a low end of 10, but typically between 15 and 25 max. So if you can see over almost 15, 20 years of data, how high we have been relatively over a given year period, we've been very high recently. We're not really, you could say that in the late 90s we were around 10 for a significant period of time. But the bottom line is that you're going to see it stuck in a range between 15 and 25 on a regular basis. A lot of people use the VIX, or, for example, does anyone know what the VIX exchange traded product is? An ETP represents exchange traded products, which are really exchange traded funds, ETFs, and exchange traded notes, ETNs. The VXN is an exchange traded note. So you can basically trade the VIX and VIX options that way. VIX options are really priced in a very interesting way. If anyone's ever traded, has anyone here in the room traded VIX options before? They aren't priced like the Black-Scholes model would have you believe. They're priced in a very different manner and can be very tricky to trade. So don't hop into something like that too soon. But when people do, they look for it as a hedge. For example, when the SPX moves 1%, the VIX will move 4%. Some days it's different. The divergence of that typical inverse leverage relationship is something that people look at a lot. Like, for example, if the markets are up 1% and the VIX is up, people may say on a short-term basis, could be complacent, or this shows us that we have more room to go down tomorrow on the VIX. Therefore, more room to go up on the indices. So there's a lot of different ways to analyze the VIX. We're going to boil it down to one very simple way to start off here tonight. Let's go ahead and move forward on that. Here's a VIX chart daily with Bollinger Bands. Now, what type of Bollinger Bands are we going to be looking at? They're key, so I'll write this down for everybody. We're going to be using Bollinger Bands 20-day, 2 standard deviation Bollinger Bands. So what this means is that we're looking at the last 20 days of price action, and we're taking that average, or that 20-day simple moving average, and then we're plotting a band 2 standard deviations above and 2 standard deviations below. That's going to incorporate the vast majority of likely price action. So we know that when it heads outside of that, it's likely to what? Reverse. Now this is an updated VIX chart from today. You can see here that most recently, let me get out. See that the price action here over the last, I'd say since the beginning of June, we've never gone inside or outside of a upper or lower Bollinger Band. That is the key that I want to point out to you tonight. What I look for are to define a market top or market bottom. A market top based on volatility, based on fear extremes, would be 2 consecutive closes outside the upper Bollinger Band. It means that based on 20 days of price action, we have a relative extreme. Does this work all the time? Certainly not. And you can see that even right here, where we had 2 consecutive closes outside the upper band, what would we be looking to do at that point?